If they're lowering estimates on all 11 sectors, why is there any reason to own equities?
Well, this is exactly what we saw in the first quarter and the second quarter. The consensus expectations were negative year-over-year earnings. And guess what? We reported positive numbers. And I think
the analysts got it wrong.
Well, to some degree, the company management sort of lower the bar by sort of sandbagging the analysts. They bring the numbers down, then they are able to manufacture a positive surprise. And I think we're looking at a similar situation in the third quarter, likely the fourth quarter as well.
I can't figure out the economy, Joe. I mean, I tweeted out a story from Roanoke, Virginia, down near Blacksburg, and they can't find bus drivers. They're offering $20 an hour and $2,500 signing bonus. There's a grocery store that they just built near my house in New Jersey, $15 an hour plus bonus to start. I see those signs everywhere. Now, maybe we have recency bias or geographical bias. How do you see the economy? Is it really slowing?
Yes, it is. We're slowing back the trend right around 1.8% because the economy is absorbing two supply shocks at the same time, both driven by policy. One obviously is trade. We spent a lot of time talking about that. The other is immigration. I don't think we spend nearly enough time talking about how tighter immigration has led to tighter labor markets, and we are seeing a little bit of bottlenecks begin to be developed, develop, as you say, around different regions in the economy. And I think that's what you're seeing, and it's what you're hearing.
7.5 million open jobs right now, Joe.
Yeah, not enough.
You think we need to bring in more workers? Because obviously we don't have them.
We don't.
If we have them, they don't have the skills, or they're in the wrong physical location for the job.
Yeah, we don't have enough willing and available workers at this point. Look, we got a really good business in Toronto. You know what Toronto is? It's the #1 startup capital in North America. You know why? Immigration policy.
Yeah, they've
that
changed.
Shouldn't be happening. That should be happening here.
Yeah, go Canada. Phil, when we look at equities, though, going back to the markets, I mean, if the economy is going back to trend, to Joe's point, at 1.8%, we've had this 10-year bull run. I mean, is it harder and harder to make the longer-term bull case? Or have companies gotten leaner and compressed their stocks, taken out stocks through buybacks?
All of that's happened. And as we talked about the last time I was on the show, we thought that there would be some consolidation in the markets in August and September and October. To some degree, that's happening. But if we're not going into a recession, and our call is still that there's no risk of recession probably until the first half of 2021, then we'll get through this. And if we can get some positive news on trade, I think that potentially would be a catalyst over the course of calendar 2020.
Would it matter anymore? I mean, the markets seem to be moving less on trade headlines. Although today we're down 150 because apparently the two sides, China said, well, we're not going to give you what you want. We'll meet, but we're not going to give it to you.
Economic news is clearly the most important. And the beginning of last week, the ISM manufacturing and service data was very poor. That sent the market lower. The pressure from negative Chinese trade issues, I think it's what's creating the pressure on the economy. So if you can make some progress on that, then potentially you're looking at better economic news next year.
Is there any indication, Joe, that tariffs, and we've done stories, I know there's individual businesses that are getting whacked. We get that. I'm not minimizing tariffs. But is there any indication that tariffs have taken down the economy as a whole?
No, but that was the prime or the proximate cause of the slowdown. And then also, you guys did a great piece earlier on GM. 2 billion hit a month, 48,000 workers. You'll see that in the initial jobless claims now, and in next month's monthly employment report, that's going to be the big story.
Do we ignore next month's monthly payroll number because of the GM strike?
Well, we're going to hang a pretty big asterisk on that.
Yeah, not to steal anything away from our future coverage, by the way.
Yeah, right, yeah, exactly.
We've also got a big slowdown, Phil, in the energy markets. We tied, sort of the slowdown in new oil and gas drilling with industrial production, right? I mean, it's not like it was 10 years ago. You can't equate oil and gas now to 10 years ago because it's double the size. It's massively important. What's it going to take for the next leg up for equities? A turn in energy stocks, perhaps?
Well, certainly stronger economic growth, because I think one of the pressures here, separate and apart from the Iran-Saudi Arabia issues, is the perceived lack or reduction in global demand for oil and gas. So unless and until you get that pickup in demand, that's what's going to drive, in terms of supply-demand balance, the price of crude higher. So if we're looking for negative corporate earnings in the third quarter, and that's the forecast, the expectation for growth being slower because of the ISM data we saw last week, we need to get stronger growth in order to get those prices higher.